So you heard what Raj Cohen had to say. This is a step in the right direction. Relief is on its way. Is that the way you see it?
We do, David. You know, we see this as a good first step to really dealing with some of the issues in Dodd-Frank that were a little bit of an overreach, especially for the smaller community banks and regional banks.
So what hurt you the most in Dodd-Frank, would you say, as a practical matter, in your day-to-day business?
Sure. You know, day-to-day, I'd say the biggest thing has been is that when Dodd-Frank was passed, some arbitrary thresholds were put in around asset levels. So for us, we're getting ready to pass that $10 billion asset threshold. And with that comes additional costs as well as lost revenue of about $15 million for us. And so if we can begin to deal with some of those issues in Dodd-Frank that really don't make sense and really weren't a cause of the financial crisis, it can really help community banks like First Financial.
I mean, you're talking about your merger with MainSource Bank and the fact that that combination then puts you over that $10 billion asset level. Would the merger not really have made financial sense then without the deregulation that we're talking about?
No, it made strategic sense for us, Julia. We really saw the MainSource merger as an opportunity for us to really gain scale. And honestly, with the increased compliance cost, with the investments in technology that are required today, scale really does matter in the banking business. So for us, moving from $9 billion to $14 billion, we think is a good step in building that scale.
So in terms of action going forward and as a result of the deregulation that we see, will you be extending more credit and I guess at more competitive prices as a result?
Well, you know, what we see is certainly providing credit to our local markets is a key part of our charter. But the other thing we've done as a part of this merger is we've announced a $1.7 billion community development program, which really is an investment back in our communities through community development lending, mortgage lending in low and moderate income neighborhoods, as well as additional direct philanthropy.
So Claude, where do you see the biggest mismatch now in terms of the demand for credit and your ability to supply it that would be addressed, at least in part, by this revision?
Well, I think a part of it, David, is the fact that it reduces the burden on us of certain things like stress testing, where Dodd-Frank put in place a very rigorous stress testing regime for really all banks above $10 billion. This new Senate Reg Relief bill really increases that level to about $100 billion. So, first of all, it lowers our cost, which is really critical. But then this merger, giving us additional scale, really allows us to move our lending limits up, where we can now do a small business or a middle market credit up to $30 million as an example.
We just heard from Roger Cohen there, and one of the things he said to us as well was actually we underestimate the burden of technology and the investment that requires, and you've kind of alluded to this too. How do you go about scaling that investment and deciding what amounts of money to put where and when?
Well, I mean, first you have to think about, we all have to protect against cyber security. So cyber risk, as an example, requires significant investment by all banks, including ours. We also then need to make sure we stay competitive with the fintechs, with the larger banks like a JP Morgan, Bank of America, who are investing heavily in mobile applications because many of our clients today prefer to really interact with us via mobile versus in person. So for us, being a smaller regional bank, we have to match those investments and match those capabilities, both on the risk management side as well as on the client access side.
Claude, tell us about the economy at the grassroots level, because you have a window into that, both with respect to consumer or households, also small businesses. Is it going forward? Is it growing? Is there increased demand, for example, for loan origination?
You know, it's interesting, David. I would tell you that the economy in the Midwest is strong. We feel very good about where the economy is. Unemployment's low. People are making investments. Companies are more optimistic today than I've seen them really since pre-crisis. What's been interesting, though, is capital investment has continued to be slow. And we're hoping with the Tax Act, with some additional optimism that we're seeing in the economy, that we're going to see capital investment pick up, which really will increase our loan demand, which has been a bit tepid the last few years.
That's one of the big hopes of the tax overhaul. Is that part of the reason why you're hoping that this will pick up?
We are, Julia. We see that with the optimism from lower taxes and honestly with lower regulatory burden, not just in the banking industry, but really across all industries, that a lot of our clients are more optimistic and they're talking more actively now about not only capital investment, but about growing through acquisition and looking for more just opportunities to invest back in their business as opposed to, hoarding cash, if you will.
If there are any alarm bells being signaled, and I'd say they're probably amber rather than red, it's on the commercial real estate side. What are you seeing there in particular? Is there anything either there or beyond that gives you pause for thought, if not even alarm?
Well, it's certainly not alarm at this point. I would say with rates being as low as they have been for as long as they have, what we're seeing is a stretch for yield, and I wouldn't say just in commercial real estate, I think in all asset classes. And so as a banker, if I have a concern, it's that people are kind of moving asset prices up in that search for yield. So as an example, in commercial real estate, over the years we've seen the cap rates or capitalization rates on those properties come down. Now in the Midwest, those are still reasonable, but if you look on the East Coast and the West Coast, we're seeing some pretty low cap rates in commercial real estate that I think could be long-term cause for concern.
And finally, Claude, what about the consumer? Does the consumer have more money in his or her pocket? Are they borrowing more? Do you see any indication of some stress coming into consumer credit?
We have not seen stress yet in consumer credit, David. We're hopeful that with this tax cut impacting a lot of the middle class, that they're going to have more money in their pocket. They're going to be able to look for opportunities to either save or continue to make purchases. But at this point, we've not seen any significant consumer stress. And in fact, we continue to see good optimism as it relates to people's own view of their household income and wealth.